now is now is not the time to say, oh, I don't think we'll get approved. Either you know what you're approved for or you have a plan. So not knowing at all is not the strategy, I think, to go about in today's market. It's good to know exactly what you can do and how that's going to work for you. So
I like that.
Right now, I think we are right on time, a little minute behind. So real quick, Garrett, just kind of give a quick intro of yourself and who you work for, and maybe share something that went really well in business lately.
Yeah, so Garrett Heisinger, American Pacific Mortgage, and I would say right now I've seen a pretty big uptick in obviously new pre-approvals, and obviously rightfully so with the new down payment assistance program that has come out. I've been in the business for going on 7 years, and I served about 6 of those years at Finance of America. I'm now at American Pacific Mortgage. Like I said, I've been here now since October, so it's been about 6 months, and it's been great. I love it here, and a lot of the people that I was working with before came over here on this side as well. So it's basically just kind of like the same team, same everything, just obviously new company. So
nice. Very good. Good. And so what's something that you feel like is going like really well for buyers right now? I know, especially like besides the program, I've noticed in, my activity in the market, a severe uptick of, people being out there. It seemed to me like once the rates kind of dropped below that like 6.5 and people could start getting into the low 6s, we had this excitement again. Is that something that you noticed?
Yeah, I think you hit the nail right on the head. I think that anytime the interest rates have a drastic jerk, I think that you see an influx of new buyers. And kind of, piggyback off of what you said, so far this year, how I describe it is that interest rates performed better in January. They got worse in February. And then for the month of March, they've actually gotten better again. And it's so funny that you say that, because it seems like as of late, I know that the narrative before was, hey, you might be able to get a seller credit, and you might be able to offer under asking price. And I don't know what happened, but in the last seriously 3 weeks, it has cranked up and it's gotten competitive all over again. And I don't say that to scare people, but more just to prepare, right? Just kind of explain the market.
Just the reality of what you're going to be experiencing.
Right. Right. And again, I think that's a reaction of the rates. So
yeah. How do you think because I know what I'm hearing a lot is a lot of people are really worried about having to compete with like a 2020, 2021 marketplace again. And so they're kind of keeping an eye, is now the time? Should I dive in? Is it going to be a situation where I'm just going to be writing offer after offer? And so in those situations, I don't know about you, but I try to just kind of go in with a little bit more strategy. You might be in a situation where we're writing multiple offers on different properties before you start to get acceptance. But that's not to say it's not worth it to give it a go right now. And while buyers are, needing to kind of keep their terms a little bit more in the seller's favor to get the offers accepted, I'm still seeing sellers accept offers where the buyers are holding on to some contingencies, unless they're, an all cash buyer and they don't need it. In most cases, they still want to have at least the full inspection reports. And so it's not so, take my firstborn and here, 200,000 over ask. So I don't know if we'll get back to that again, but I think it just is feeling like a good, healthy marketplace, which is what we need, because we need the inventory, right? I mean, we're still like less than a month's worth of inventory. But that's why I'm excited to talk about this program, because I really think that it's going to kind of help push some of the inventory I'm hoping, and that a lot of people will see a little bit more of a buyer pool available to them, and now a buyer pool that has access to more funds, right? So I'm
Yeah, for
hoping it
sure.
encourages some sellers to want to list their property on market soon.
Yeah, no,
Nice. Yeah,
100%, 100%. I know that, the biggest thing has, always been inventory. And I know that, it's absolutely correct. We are in a housing shortage still to this point. And, the demand, I think, will continue to be there until further notice.
right. Yeah,
Right.
yeah,
So,
TBD. We'll see.
yeah, yeah. But no, this program, I think, is going to provide a lot of opportunity for those that are able to qualify for it. I think that, like I said, I've ran it past through a few people that had already been previously pre-approved, and then we threw them on this program. And I mean, they're saving probably, I've seen $400 on a monthly payment in terms of difference for what this program can do.
I mean, yeah,
Yeah.
and especially when you're going from hundreds of thousands into a whole nother bracket. I mean, it's opening up doors for a lot of people, and to be competitive, right? Because some sellers are really wanting to see that 10, 15, maybe even 20,000 over list right now. I know I've had some clients that are in that kind of competitive range.
Mm-hmm.
So with that said, I know we have some questions that were sent to us
Yeah.
about some questions about how to qualify with the program. So we'll go ahead and answer the questions.
Yeah.
Then let's wrap up with anything you feel like is left out. And also I'd like people to understand about these home down payment assistance programs. I'm going to pull up the questions that we had on the email.
Yeah.
Because there's a little bit more qualifying on the back end for that, right? You have to maybe do some of those first time home buyer courses. And so, yeah, let's just make sure that we're, obviously we can't qualify anyone over the Zoom, which would be amazing if we could.
Yeah,
but
right.
we'll answer the basics. So the first question we have is from Brandon.
Mm-hmm.
I'm not going to share a full name, so it's Brandon F. So he asks, will the new program be able to beat out any kind of VA programs available? And how are you seeing them compare?
Phenomenal
I know it's
question.
been a day, but in the 24 hours.
No, for sure. You know what? VA, wow, that is just such a great loan product. And, obviously, we thank all of our veterans that have served. And so for the VA program, that program really can't be beat in my mind. And I don't think that this 20% program really, you really can't compare the two. So what VA really allows, it's 100% financing, and there's no PMI, meaning no private mortgage insurance. And so, for the VA loan, you're not having to, when you do go to sell or refinance, you're not having to pay back anybody any money. And so I think that in and of itself kind of takes the cake over the, the Dream for All program. But that's primarily the biggest comparison, is that on VA, it is 100% financing, meaning no down payment required. You are just, needing at that point, just needing to come in with closing costs. But yeah, I would definitely still stick with the VA financing. And for the reason why is because when you do go to sell or refinance, you're not having to pay back anybody money.
That's good.
Yeah.
Okay, very good. Yeah, because I know a lot of people are like, oh, this almost works like 100% financing. Can I just do this versus VA? And, and the reason why this question was asked for Brandon in particular is because he was interested in getting in to a property that he felt would go easier conventional. So in that situation, if you feel like there might be an issue with it being VA, could they switch to this type of program and maybe refinance later?
Great question. And I hear Brandon on that. I know that, you can speak on it as well, right? Like listing agents, when they go to look at offers, the first thing they're looking at is the conventional financing, right? And then the FHA and VA kind of follow suit. So totally respect that question and totally understand. Yeah, can you switch, I think your question was, can you do the conventional program and then after, can you refinance into VA? And the answer is yes, you can, but we have to remember that when you refinance out of this conventional program, you trigger the repayment of the loan. And so what's going to happen is that you're going to have to repay back the money that you borrowed, number one. And then number two is you're also going to have to pay back basically the shared appreciation, that from the equity that you've gained, while living in the house. So can you refinance into the VA? You can, and you can still get the benefits of it. But I think it almost defeats the whole purpose by going that route in and of itself. I know that it might be hard for, for VA financing up front, but I just think you got to keep taking a crack at it. And touching on to the point that you made earlier is making sure that your offer is super clean, right? Contingencies are super slick, super nice, and just writing an overall good offer. So,
and on the listing side of that, that's why I always advise my clients, my sellers, let's go in with full reports. Let's go in with eliminating as much hesitation and questions as possible, because then that's when you get the offers where the buyers are comfortable removing all the contingencies or not asking for repairs. And so, I love that. And thanks for that perspective, because I know a lot of people are like, how does this compare with some of the programs that were beneficial before? So Jessica asks, can I still contribute my own funds with the 20% so I can purchase even more, or whatever the case is? How does contributing your funds with that work with this program?
Yes, absolutely. And you can absolutely do it. You can, I call it double stack. You can definitely double stack. It is absolutely okay. If you have funds that you wanted to use and you wanted to basically double stack it with the program, you can absolutely do that. I believe the max that you can contribute from yourself, I believe, is 30%. So you can use 30% of your own funds, and then I believe you can take 20% from the program. So you can have a total of all in 50%.
Now, this is my question paired with her question, because you just said that in that situation, if you're coming in with like a 50% where your ratio is under 60, then can you get an appraisal waiver in that situation?
I would say, yeah, absolutely you could, because your appraisal waiver is really just determined by the DU system, DU standing for desktop underwriter, which is what all, mortgage lenders and mortgage platforms and bankers across the nation kind of run for conforming loans. And so, it really just kind of depends on that. If the DU thinks that, based off of the overall profile, right? So like based off of the borrower's credit scores, based off of the debt to income ratios, based off of how much money they're putting down, all of that kind of goes into the appraisal waiver factor. So,
which could be very helpful for someone with this program, because it is, which I'm sure you'll touch on, it's a program for people who have a healthy background. It's not, extremely low credit scores. So somebody who has a situation where maybe they are competing against multiple offers and waiving contingencies and competing against cash, they might be able to position themselves where they can waive an appraisal and accept seller's inspection reports and just be writing on a quick loan.
Yeah, absolutely. I definitely think that. I definitely think that this program, like we've talked about, definitely is getting a, first-time home buyers a little bit more of a fighting chance, right? Especially in this market. So
that's what I like. That's what it is. It's really about just getting your toe into investments and into home ownership in some way or another. And then, then going forward, instead of being in that rental game for so long. And, statistics show, I can't quite remember where I heard it. So, but I heard along the way that you really don't see the benefits of home ownership costs until about year 3 is when you start to really feel like your mortgage payment is more beneficial than what you were paying in rent, for example. And so in my mind, if you're always renting and you're kind of scared or hesitant to make that next call, and if you should just get into something, whether it's a townhouse or a condo, something where you could essentially rent to yourself for a few years since you're renting anyway, and then, keep it as your future real estate portfolio, or, turn it around and sell it and then use that equity to finally get into the house you want maybe in a couple of years later. But if you're not making that call, you're kind of like 3 years behind the game all the time. So
right. No, 100%. And I think that, shoot, where was I going to go with that?
it's good.
Yeah, I
Well,
apologize. I completely
no, that's all
blanked.
right. But the other question we had though was about what it takes to get access to the program. Because I know
Yeah,
some of these first time home buyer programs, FYI, my neighbor just took up drumming. So I don't know if you can hear that.
I can't hear a thing.
I can hear it and it's just like boom, boom, boom. He's not that great yet. He'll get better. So but they want to know, because I know they have to take like special courses, right? So how does that work? What can they do to make sure that they can still move along in an escrow very quickly and not be hit with something, last minute, especially with programs like this?
Yeah, so a first-time homebuyer course is required to be taken, and it is like an online education course. And so in order to basically keep up with the timelines, you're right. I mean, you basically just have to prioritize getting that done up front, right? And maybe not so much on the back end. I have had clients take them before, and you are able to knock them out relatively pretty quickly. I know that they are, I believe, I want to say that it's like an 8-hour online course, but I think you can knock it out even sooner than that.
And do they have to wait for them to be in escrow for that? Do they have to have the property identified, or can you start that course before?
Yeah, that's a great question. Off the top of my head, I don't know the answer to that, to be completely
Okay,
honest.
I
Yeah,
want to say I had thought they had to be in an escrow for that to kick in, which is why we have such a tight time frame. But
right,
like, say we find out, because there's so many rules and regulations that change with all these different programs. So if we had like all the
right.
answers right away, that would be amazing. But say you do have to take this course, and you can't take the course until you've had that property identified, sort of like ordering an appraisal, right? There's no point in ordering it. Property's not identified yet.
Right.
I just suggest that if any of you guys are going down this route, that you definitely make sure you're structuring the plan, because especially with, and I don't want to say that it's going to be harder to be accepted with this type of loan option, but you will have to disclose that there's some sort of a second financing going on.
Sure.
It's straight conventional. So some sellers will be aware of what needs to take place. So if you have an agent that's helping you structure these types of offers, like what I'm going to do with my clients, for example, is we are going to lay out everything that they have done. We know the timeline of everything that they need to be held accountable for. We know who to call and when to plug it in. Because what the biggest thing is that these agents and the sellers just want to make sure of is that the ball's not going to get dropped, that everyone's going to stay on top of this different type of loan. So I think that good cover letters, your agent coming in with really good rapport with a listing agent, making sure that this is very well explained, that they understand that your agent has the team behind them that is going to see this through. Those are the people who are winning right now, because especially when you have the 8-10 offers on a property, the people who stand out stop really being the list price, just being the list price, or just waiving contingencies. When everybody's starting to look the same, it's the team. It's, was the lender very quick with response? And I know you're amazing at that. So, and how quick was the agent with, responding back to the listing agent? Did they, pay attention to the MLS notes and try to get in touch with the listing agent the way they prefer to get in touch with? And so it's all the little things that help your clients get their offer accepted, right? Because you're creating this experience for the listing agent to show them that we're going to get this done.
Totally. And I'm sorry, I apologize. This is
Yeah, the sun just dropped right on you.
Right? So there we go. Now we got that fixed. Yeah, no, you're 100% correct, right? I mean, that's what I think makes good offers, is having, good agents and good loan officers working hand in hand. I said that over a video, I think like 2 days ago, that I posted. I think that makes the world's a difference. I really, really do. Working with the right people. So.
Right. So what else before we go? What else about this program do people really need to understand, or kind of some key points on what to remember?
Yeah, so I think the main qualification points are 680 and above. Mid FICO score is what's going to get you qualified for this type of program. If you are above a 700, it's preferred, because with a 700 FICO score, you're able to bring up your debt to income ratio to 50%. If you are between 680 and 699, you have to stay 45% and under for debt to income ratio. So that could be big. That extra 5% could be the difference of you getting qualified for 400,000 and 450,000, for example, just for a quick example.
Right.
So credit requirement, income requirement. This is a big one. It goes based off of county. So I know that for Sacramento County, I believe the income limit is 202,000, which is obviously amazing. And so I know that each county has its own specific county loan limit or income loan limit. But for 202,000 here in Sacramento County, that's obviously really, really good. So that's number one. If you make under that, you're good. If you make over it, like I said, if you make over that amount, you wouldn't qualify. But if you're under, you're good. And then, obviously being a first-time home buyer, I got a question today in regards to occupancy. Like, can I have a co-signer? The answer is yes, you can, but your co-signer must also occupy the property, meaning that they live in the property, and they too also must be a first-time home buyer. So I actually, a mom and daughter, for example, are looking to team up and qualify together. They're both first-time home buyers, and they both plan on living in the property together. So that would be eligible.
Or
For the
maybe,
program.
a couple who's not married on paper.
Yeah, correct. Yep.
That's perfect.
Yep. Same thing.
Okay.
But yeah, those are the real basic qualifications for it. The biggest thing is really understanding, what is going to happen when you sell or when you refinance. And I know that, like I mentioned before, you're able to get up to 20% of the purchase price that you can use towards your down payment and or your closing cost. And so obviously that money you pay back. And then, as I mentioned, they're going to take 20% of the equity that you've gained in the home. So the example that I'm constantly using is, let's say you buy a house for 450, and basically 5 years down the road, you're able to sell it for 500,000. You've gained $50,000 in equity. The program is going to take 10,000 of your 50,000. So you're still going to end up with 40,000, but they're going to take 10,000 of it, because that's 20% of the equity. So that's obviously, something super important to understand is, what is being repaid come time to sell or come time to refinance.
Well, and sometimes we pay for convenience, right? It's convenience. You in some situations would never have been able to buy a house without this type of program for some reason or another. So now here's a question that I was wondering was, what if some people get into a situation where they have to sell before any shared appreciation has been earned in any way? Like, for example, say they buy and 2 months later they have a job relocation or some life event happens. What's that look like?
Yeah, so if there's any equity loss, you don't have to pay back any equity, because there's no equity to share, right? So at that point, the only money that you're having to pay back is the money that you did borrow, which would be the 20% of the purchase price that you still pay back. But there's no equity or appreciation share that you would be having to pay back, because there isn't any. So yeah, that's a good question. I had that question asked myself, and yeah, if there's no appreciation or if there's loss of equity, there's obviously no 20% that you have to pay back on that.
Okay, so just the 20% that you use to get into the house initially down, which
Correct.
Essentially you would use with the proceeds. You pretty much wouldn't make any money off of selling your house for a period of time. But again, it's that or continue to rent anyway. And we're talking crazy life events that in most normal cases, people will be holding on to their properties. That would not be the case. I just was wondering, we have like military families and people that move, although they would be using VA. So that wouldn't be the case for them anyway. But yeah, so very good. Is there
Yeah.
anything else that you can think of that we should just kind of make sure? Again, I'm going to make sure everyone has your information. So if
Yeah.
anyone has a quick question or like, hey, what about this in my situation, they can always reach out to you. But before we wrap up, was there anything else that you wanted to note?
Yeah, no, I think, and I think kind of circling back to what you mentioned earlier, I know that, um, the media, right? I know that the media portrays that there's a lot of uncertainty in this market, and being, yourself a real estate professional and myself a mortgage professional, we can, I think, confidently say that we see this market and we see how competitive it still is, and how healthy in the sense of appreciation and value. And so I think that for people looking to buy and wondering if it's a good time, I think the best way to answer that is you have to answer that question yourself, right? If you're in a lease that's ending, or if you're in a situation where, you have to be out, or, a growing family, or, or anything like that, it's really up to you to kind of decide, is it the right time for me to buy, right? Because getting into real estate, I think that you really see the value and the gains that you get, and the wealth that you build through time, right? This isn't something that you get in for and then you get out and you make your money and then you're done. No, it doesn't work like that. This is a different avenue for wealth, another avenue for wealth that it takes time to build. And I think that over time, historically over time, it is proven that you can build wealth in real estate. And so I think that with that in mind, I think it really doesn't matter when you jump in, right? Because if you jump in when it's up or you jump in when it's down, at the end of the day, if you plan on being in real estate for a very, very long time, it's not going to matter if it goes up or down, because it's all going to be relative at that point. And again, historically, it goes up. It goes up. And I'll leave with this last little stat. Historically, I think the appreciation rate in Sacramento County, I think, is like 6% year over year. And that's going back like, I think like 60 years, I think, from, for that stat. So, it's healthy. It's healthy buying real estate. I know that the '08 and '09 kind of, scars the industry a little bit, but like I said, you can speak on this as well. I think that this is something entirely different. This is the opposite, right? I mean, inventory is so tight that demand seems to it's going to have a stronghold on this for a while. So
Yeah, I almost think that they have to keep the rates where they're at, because I mean, we saw when it was dropped even just like 1/4 of a point, quarter of a point, it all of a sudden stirred. It was like immediately that weekend. I think when SVB Bank went down and they made adjustments, it was boom that weekend. And
yep.
we're seeing comp setters again, neighborhoods that never saw something over mid sevens, they're getting offers in the eights. And so people are wanting to move their equity around. And I think that's what's really different about the market right now too, right? Is people want this healthy equity, and they also really want to make sure that they're making smart moves. Some of the new buyers and the people who are out there right now, they were the kids that experiencing losing the house, or saw their parents going under.
Point.
And so I feel like, we're just not making those same decisions. You're not seeing somebody who works at Starbucks get a $500,000 home loan. That's what's not happening these days. So I agree. I think it's still a heavy market, and it's something to be really strategic about, but it's not something to be, nervous about what the stability is like here, because the back end is not as predatory as it was before.
Oh gosh, no. And that's such a great point. The way that loans are underwritten nowadays, I mean, it's pretty hardcore. It's pretty hardcore. And
even those 2-1 buy down ones where you're getting the low interest rate, because I know a lot of those adjustable rate mortgages, when they started coming back around again, it made people nervous, right? But what I told people was, back in '08 in the early 2000s, they would qualify you on the low end. And with
Right.
these new programs, you do get qualified on almost like worst case scenario.
Yeah.
And we were kind of pretending like worst case scenario was never going to happen back then.
Right.
And then it happened. So again, like there's just so many differences in how they're trying to protect it from not having to experiencing that again. So
Yeah, it's so funny because the 2-1 buy downs have because we've been so conservative for so long since we came out of that, you know what I mean? Everything went belly up. So immediately you turn to being conservative. And we've been so conservative for so long that the 2-1 buy down programs almost seem like if they were like taboo, right? And they're not, they're super safe, they're super
you should have
clean.
seen agents' faces when they were like, "Oh, how do I tell my client that maybe this arm might be good for them? I don't
Yeah,
want to bring it up, you know." And
yeah.
it's
No,
completely
it's
different.
yeah,
So
it's for sure, for sure. But no, it's like to go for full circle again, it's really dependent on the situation, I think, in terms of buying. But yeah, I think really, if you plan on being in this long term, it doesn't matter when you get in.
yeah, and it is real estate. It should be generational. It, you
Right.
know, real estate properties that you can leave your grandkids, things that will exist beyond your time that can fund a good healthy life for you now,
Mhm.
but that will still exist beyond your years. So yeah, I agree. I think that that's really good, a really good point to make here. It's
For
the
sure.
long game.
For sure.
Well, thanks, Garrett. I really
Yeah.
appreciate your time tonight, though.
Yeah, thank you. I appreciate you. Thank you for having me on and for asking me those questions. Really good questions. So
Yeah, it's great stuff. And if anyone has any other questions to send us, we can get you answers. And yeah, maybe we'll do another what's going like a money talk, what's going on with the loan and leverage these days.
yeah, absolutely. I think that'd be great. I think that if there's any additional questions or any other additional ideas that you even have, Amanda, please let me know. Would love to jump on here again with you and just talk,
Yeah, chat it
So
out. Really
yeah.
cool. Thanks, Garrett.
Cool. Thanks, Amanda. Appreciate it. We'll be in touch.
Yeah, bye.
Okay, bye.